In this video, traders, we're going to look at how do you manage overnight gap risk on your trades. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is one for those of you who are perhaps day trading at the moment and are looking to transition into holding trades a little bit longer. Because put it this way, if you're day trading, great, you're in and out, whatever you make in the day, you make in the day, you end the day flat, you sleep, you get up, you do the same thing again the next day. There's a certain value to that. However, there comes a point where if the market conditions are right, you want to be holding stuff overnight. You want to be holding that trade that you've made a nice, good entry on, dip in the morning, dip at lunchtime, whatever it may be. You bought, it's pushed up, it's closed at highs. You know that it's likely the next day you're going to get follow through. So you don't want to close that position. You want to say, hey, I want some more meat from this trade. I want to kind of push on. Whereas a swing trader out there goes in knowing there's overnight risk, knowing it's going to hold it for multiple days. It's part of the deal. So let's look at ways that we can manage the overnight risk. And this is quite a popular topic and one that I've thought through myself plenty of times, going from holding positions in a day trade to trying to look for those 3-day, 4-day, 5-day moves. This becomes quite a meaningful subject to think about and go through. So the first thing you've got to think about is your position size. What is the worst that can happen? So if you're in a position size that you're day trading with, that may not be the size position that you're comfortable with trading overnight. So you look at the potential overnight gap risk and say, hey, would I be comfortable if the price gapped that amount with the position size I've got? If the answer is no, always dial down the size. That's always the answer for a lot of things, guys, is dial down the position size, dial down the risk. When you're comfortable with the position size, things become a lot easier. And the last thing you want as well is to have a great trade during the day. It's pushed on nicely, made a nice bit of money. You hold it, then overnight the gap undoes all that hard work and it just leaves a bad taste in your mouth and doesn't really let you then encourage you, should I say, to explore the opportunities of holding stuff overnight. So let's look at the different things we could be trading, how we can manage this risk. So the first thing is if we're trading currencies, obviously from Monday to Friday, they're open 24/7, Monday to Friday, 24/5. So they're always going to trade overnight. Whatever size you've got, most of the time for the retail trader, liquidity risk isn't apparent. If you're trading the major currency pairs, they are unlikely to move dramatically without stopping out. So the easy and obvious thing to do is to just put a stop loss in that will be pinged off overnight. Might the spread widen if something kicks off? Yes, but if you're in Euro, if you're in USD, JPY, GBP, from Monday to Friday, you're probably going to get stopped out without too much damage. There might be some slippage there, but not too much damage. Now, comes to the whole, of course, the first thing that comes to mind is the Swiss move. Now, these things do happen. Are they rare? Yes, they are. Your best way of combating this is to just look and see if you're trading against something that might happen. Is there a rumor coming out that this could be devalued? You should know the currency pair you're trading. And people who are trading the Swiss who didn't know hadn't done their research. There was a potential that this might happen. This was an overhanging idea. It didn't just come out of nowhere. Sure, the action came out of nowhere, but there was always a chance, a slim chance. You know, at the moment, you're looking at the euro or the pound or whatever, there's no news of something like that happening. Sure, it could move overnight. Some sort of extreme news could happen overnight, which might make it move 200 or 300 pips, but your stop should be triggered with a little bit of slippage. The 1,000, 2,000, 5,000 pip gap move is less likely. So FX pairs, you're going to protect yourself in the majority with just using a stop. That's fine. However, now let's look at stocks. So stocks obviously close 4:30, 4 o'clock, 9 o'clock, wherever time you're looking at it, whichever country you're in, whichever country you're trading. And that's it. You don't get opportunity then to trade at all. Yes, if you're trading directly on the exchange and the NASDAQ, etc., you can trade overnight. But if we're talking spread betting, UK, CFD, actual stock or whatever, in the UK you can't trade overnight. In the US you've only got the on exchange stuff. But so assume there's a time period, whatever that may be, when you are vulnerable to a gap move. So what could happen? Stuff could come out that says earnings could come out. That's an easy one to manage, guys. Just check on your calendar if earnings are coming out. Easy. Make sure you're not in a stock where there's earnings coming out. Also, make sure you're not in a stock where another similar company's earnings are coming out in the same sector. So a rival company, you know, whatever sector you're trading, mining sector, technology sector, whatever it may be, because even though there might not be earnings coming out on the stock that you're in, because it's a very, very similar stock, if they come out and say, hey, this business model is screwed, it's been really, really bad, you can bet that your stock that you're in will gap according to the competitor's earnings. So just being aware of that, just being aware of the earnings calendar. Okay, next thing is takeover target. This is a big one. This is the kind of one that always used to concern me a bit when I was holding stocks, especially in stocks in London Stock Exchange overnight, because we had a little bit of a spell with loads of M&A going on. So you can't combat against this. However, you can align yourself on the right side. If there are rumors of takeover, if there's any suggestion that this thing could be bought out, do not hold an overnight short. Because yes, there might be a great trade, it might be a great set, it might be this and that, but that will overrule everything. That thing could gap up 20, 30%, which is going to clear you right out if you're trading on margin, you're trading aggressively for something that normally moves 2% in a day. So if there's any slight hint of a takeover, do not trade it. So even if there is no rumor of it, you also want to be sure that you're not trading on the short side, the smaller company in the sector, the one that could get swallowed up. You know, you're okay trading short some of the larger stuff because nothing's going to come along and take it over. You know, some of the really big cap players, it's less likely, never say never, but less likely someone's going to come along and just buy it because A, it's just a massive market cap which other companies don't have to spend. Yes, there might be mergers and stuff, but the point is if you're trading a small company that's very much in line with some of the bigger companies, that could quite easily get swallowed up for a 50% premium, and they could bolt it in and you'd be stuck on the short side of that in severe pain. So just being cautious. It doesn't happen very often, but it's something to be aware of. And it not only comes in fits and starts as well. You know, normally it's just self-awareness around the stock that you're trading. It's awareness of when the earnings are, what's going on around it, what's the sector doing, not just the game of, hey, is this a technical trade? Is this a good setup? Is this a good risk reward? All right, and other news as well. Listen, the way that I approach this is, if you're trading, generally speaking, okay, this is a real generalization, but it is generally true, generally. If you're trading a bullish stock, so a stock that's been an uptrend, it's chugging along, bad news normally doesn't impact it as well as good news. So if you're aligned with the trend and you're long and you get bad news overnight, yes, the point is you're going to get more likely to be good news because it's bullish, the underlying sentiment is bullish, there's good news generally coming out of it, there's growth, there's all the stuff behind it that's causing the uptrend. So the first thing to think about, number one, is there's more likely to be good news out than bad news. So that's the first thing. So if you take it as 50-50 and say, well, I might get good news, I might get bad news, I might gap against me, I might gap for me. If you're trading with the trend, the chances are it's going to be good news. So that's one thing to think about. The second thing is if it is bad news, generally speaking, it's not going to be as brutal as, or sorry, not going to be as a big gap move as good news would be, because again, the wind is behind it. And often people see it as a buying opportunity and buy it, unless it's obviously horrendous news like the company's going bankrupt. But then you've got to look at the odds of that happening. If you're in an uptrend and everything's good, are less likely. They could have done something they shouldn't have been doing, of course, but there's always that inherent risk somewhere along the line. But you've got to go with the odds of the game. The game is with odds. So aligning yourself with the trend helps that. If you're long in a really downtrend market, hammered, the news could hurt you far more. So the way I look at it is, say it's 50-50, you'd think of a neutral, but if we're in an uptrend, generally the news is going to be bullish. That kind of swings things in my favor for staying overnight long. And then I'd say, well, actually, if it's bad news, generally it's never going to be as bad as good news will move it. So that swings it in my favor long. So yes, there is still risk, but I'm playing the odds on my side. And then also back to the main initial point of, if you keep the position size low, it's never going to damage you that much anyway. So align yourself with the trend for overnight stuff. Watch out for takeover targets. Don't be going short stuff that's a potential takeover target. Keep your eye on your earnings of your stock and your sector, and keep your position size sensible. And then, in my opinion, you've eliminated a lot of the risk. Yes, there's always going to be risk there, and yes, you can always get caught out by it, but the point is you're just reducing a lot of the risk. And FX, just making sure you're trading the big pairs, not the minors, the minor pairs. Make sure that you've got a stop loss in for any overnight stuff happening, and that should help you feel more comfortable and confident holding stuff overnight when you're asleep, when you haven't got control. Because bearing in mind, guys, you've got full control of the risk when the market's open. As soon as that market closes, you give up that risk. And so you've got to make sure you do your due diligence and understand what you're giving up. And if you're comfortable with that, that's fine. If you're not, then don't play that game. All right, guys, see you next one. Take care. Keep your risk managed, whatever you do. Bye-bye.